Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Thursday expert, Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing well. I want to talk to that. I want to talk to the audience who are going through their first bear market, maybe their first recession, and just remind them that, yeah, that times are scary. I will tell you that just like good times never last, bad times never last. But when you're in it, that's hard to appreciate. And I just want to remind folks that sometimes doing nothing and being in cash is the right answer for you. So I'll leave it there. Kind of, what do you think of that statement? Do you agree,
Yes,
disagree?
I think doing nothing is often the best choice, and it could mean a lot of different things, right? It could mean doing nothing by being in cash and not being invested in the market.
Mhm.
It could mean just staying in the market and just riding it out if you're talking about the stock market, right? If
Could
you're
be.
if you're in index funds and you're like whatever, you're not gonna like your index fund is not gonna go bust, right?
Right. It won't
Maybe
go to zero.
companies in it will, but your risk, you've spread your risk across the whole index, right, of companies. That, the Great Recession is a great example of that, right? The market tanked. If you sold because it tanked because you got scared, that was bad
Right.
because it just came roaring back, and then you were out of the market when it came
Mhm.
roaring back. Real estate's the same way. If you own a good asset and it is cash flowing and you're
Yeah.
making your debt service and you have a reasonable margin of safety, meaning that even if you lose a few tenants, you're still going to make your debt service, you can just ride this out. There's no reason to panic sell the property. You just keep on holding it, right? So doing nothing is the best thing to do. The worst thing to do is react to the news in a panicked way and sell, you know, unless I would only say that if you're smart enough to sell sort of at the top,
Mhm.
right? That's one thing. But I mean, who can time it, right?
Mhm.
But you sell near the top and then you get back in at the bottom. That's hard to do, right?
Yeah.
But there are sophisticated players who, it's not like they sell at the top and get at the bottom. But what they're doing is, as the market is rising, they're starting to take chips off the table
Mhm.
because they know that what goes up must go down again, and they
Right.
want to be ready for it. But it's not like they're waiting till the last minute and then selling everything and then trying to put everything back in the market at the bottom. They have sort of a strategy of selective liquidation of assets that they think are overvalued.
Mhm.
They're not going to cry if you know there's still some upside left after they sell,
Mhm.
because this is part of a thought out strategy of stockpiling cash for what they know is going to happen, and then they're going to dive all in. And you and I have talked for, I mean, we used to talk about it a lot before COVID, and then COVID sort of like just took over everything, right?
Right.
But before COVID, you and I were talking about guys like Sam Zell and Warren Buffett who were looking around and they were stockpiling cash like crazy,
Yeah.
sitting on billions and billions of dollars because they were like, you know what? I've made my money. I'm taking chips off the table because I
Mhm.
want cash, because I know that there's a buying opportunity coming and I want to be ready for it.
Yeah.
We could
That.
have anticipated COVID and then the government response, which was just to like massively dump money, on the world, inflating all these assets. But now, look what's happening. Now we are starting to pay the price for that
Mhm.
because the Fed has got to take the punch bowl away, and
Yeah.
they have no choice. It's come out in inflation. Inflation is essentially the economy being drunk,
Yeah.
right? And
Exactly.
now they've got to it's like last call, buddy.
Hmm.
So
Yeah.
the hangover is coming.
Yeah, what I would tell someone who's going through this the first time is, I remember being, first off, I remember being that person who thought making money was easy, got confident, got cocky, and then lost 80%. So I know what that feels like. It sucks. I also will freely admit to being an emotional investor, right? And now what I tell people is, hey, if your portfolio or whatever you're invested in, whether it's real estate to crypto, wherever it is on the spectrum, if it keeps you up at night, that's a sign that you're overinvested, in my
Yeah.
opinion. But yeah, back to your point about index funds and the like, if you have different piles of money, right, and you have your 401k or retirement money in an index, it's kind of the deal, right? It's a roller coaster. You kind of leave it there, but uh, if you have your emergency fund in an index, that's probably not a great idea, right? Your emergency fund, as people are learning, needs to be in cash. That's the whole idea of emergency fund. Putting your emergency fund in chasing 5-6% because I don't know, it's worked before, not a great idea, right? Having cash is okay. Being fully invested all the time, I'm not a fan of that. So having some cash is okay.
Yeah, and not just for the opportunity, but I mean, you make a good point for the emergency. Like that should be the most conservative investment we have, which is cash, right? And or we talked about money markets, like before money markets used to be that where you put that
used
money,
to be that place, yeah.
Get a little bit of interest on it, right? And there's that, but there's also, I think, what, especially for people who have never witnessed a down market before, and the idea that the market is always going to go up, they've got FOMO about keeping their keeping the dry powder on hand. And what they don't realize, and they're like, oh, well, inflation. And now, the inflation argument is even sort of more potent than it was.
It's actually got some teeth.
When inflation was 1.8%, really was not a very potent argument, although people made it all the time. Now, that it's 8%, it has a lot more teeth. Nevertheless, losing 8% to inflation, or let's say 16% over 2 years of inflation, if it stays this high, is not as bad as losing 30% of your money because you invested it at the top of the market in real estate or in stocks
or whatever,
something else, whatever it is. You'd rather just, then you can, if you like those assets, you can just buy it cheaply again when the price comes down, but you can't do that if you don't have the cash. And so it's like, so there's a double cost to being over invested, right? You miss out on opportunity and you also lose the money. Right. So it's, and I've been telling people this for a long time. People called me foolish because the market was going up. I mean, so the market goes up. It doesn't mean that this is not, that you shouldn't have cash on the side. All those big guys like Warren Buffett, Zell, all those guys, massive amounts of cash on the side, even though the market was rising, because they knew that can change in an instant.
Absolutely.
And they want to be ready for that. And it wasn't like they're out of the market. Like
no,
they're not
of course
out
not.
of the market. They're in the market, but they're getting more and more selective about what they're continuing to own, and doubling down on stuff that they really feel confident in, also that they think is going to ride it out or has long-term value. They don't care about sort of fluctuations in the price, but they need cash because when the inevitable happens, that's when you really make money. Like that's when money buying cheap.
The best example I have of having cash on hand is still Warren Buffett getting 10% plus warrants from Goldman Sachs. Right. Goldman Sachs, pristine, but even they came, I don't know, necessarily think hat in hand, but basically said, hey, we need to shore up our reserves. Warren Buffett, you're like one of the last guys standing with cash. We'll basically give you everything you want. And, he made a lot of money by holding that. And then the warrants, I mean, he printed billions of dollars. It was amazing.
And listen, I mean, JP Morgan did this in the panic of 1907.
Absolutely.
Right? I mean, like he was the guy who had the money, right? And like people were all the famous panics of, the panic of 1873, the panic of, it was like 1857, 1873, 1893, 1907, right? And like, I think it was, what was it, like the Great Depression before the Great Depression was like, was it 1893? That was, they called about the Great Depression. I think that was the one.
Yeah, late 18, yep.
Yeah, and then the Great Depression happened and it was even worse. So, but the guys like Jay Gould and Vanderbilt and those guys always use those, Rockefeller used those as opportunities
for sure
to buy out their rivals, like pennies on the dollar, right? To pick up. I mean, that was their MO, right? I mean,
cash is an option on future opportunities. That's what it is. Exactly. Yeah. So it's amazing stuff. Again, folks, I just want to tell you, if this is your first time going through it, it will end. I promise you that. I can't tell you when, but it will end. Good times will come back. I do think We had the last 2 years was easy money. The next 2 years will be very hard money. But again, there will be some people that do great things. They will buy amazing assets. There will be legacy wealth built in the next couple of years, but that also means some people are going to lose. So again,
Well, let's just talk about this a little bit more, because
sure.
we do have a couple more minutes. But I mean, so technically speaking, anyway, right?
Yep.
For recessions,
Mhm.
I mean, the pain lasts longer because it does take time for employment to ramp back up, things like that. However, really, I mean, at the longest, recessions last about 2 years, and most of the time they're much shorter, right? And financial crises tend to be longer because when you have a liquidity crisis,
Correct.
and it takes a long time for banks to feel comfortable lending again, right? So that they last longer and they have to unwind all those bad positions. But on the other hand, sort of individually speaking, even kind of like worst case scenario, usually doesn't, even in a recession, right? Let's say you get 10% unemployment. It means that 90% of the people are working. And it means that as an individual, generally speaking, within 6 months, you can find a new job if you lose your job. Yep. That's why you need that 6 months reserve fund in cash, right? To tide you over through that period. So even if things do get bleak, what you need to know is if you've prepared for it, you can get through it. You'll see daylight on the other end. And it's not, the recession may continue, but your personal recession will be over, right? And then if you're really well prepared, there will be opportunities. And the other thing is that the amount of business creation that happens during recessions is pretty amazing. Pretty amazing, because people lose their jobs and they're like, well, time to start a business, or I can't find a job, I've got to start a business, or I hated that job anyway, I'm going to start a business. So there's a lot of great stuff. It's like the winter, right? Like if you think about it, it's the winter for the economy, when like all the seeds run to the ground, like all getting ready for spring, and then spring happens and all the green shoots come up. So don't despair about a recession, but don't despair, prepare. Right?
Yeah, that's the whole thing I'm trying to preach, is you need to prepare for it. I've been talking about it pretty hard for the last 6 months. Prepare for it so you can thrive. Yeah. Again, recessions are where real deals are created. You're buying assets on sale, and these may be things you hold forever. I have several apartment buildings that I bought at the bottom that I will likely never sell because they were bought at such crazy prices. So, yep. Jonathan, where can people find you?
Yeah, so you can find me on Facebook in the multifamily investment community. Just search for it on Facebook and I'll let you in. You can also find me on my website, Two Bridges Asset Management. Just Google it. It's easier to do that than for me to tell you what the URL is. I have an active deal. If you are an accredited investor and you want to find out about the deal, go to the investor forum at Two Bridges Asset Management, and you can get on my list, and I will mail you the details. And if you want to learn about how to be a syndicator, or just how to buy apartment buildings the right way, even if you don't want to syndicate, if you've got the funds to do it yourself, you can join my coaching program, which is very reasonable. And you can find that at multifamilylaunchpad.org/join.
Awesome. Thanks, Jonathan. Thanks for the week.
Thank you, Michael. Absolutely. See you next week.